All right, let's get right into it. Today, we're unpacking a story that's sending some serious shockwaves through the entire global economy. And it all starts with one single, pretty staggering number. $116.85. That was the price for a barrel of Brent crude oil, the big global benchmark, that popped up on trading screens. And to give you some context, we haven't seen a price tag that high in almost 4 years. This isn't just a number on a chart, it's a financial gut punch.
And this quote from Upstocks really nails it. The world pretty much woke up to a crude reality. See, that $100 mark, it's more than just a number. It's a huge psychological barrier. Blowing past it like this sends a jolt through the whole system and gets everyone worried about supply, inflation, you name it.
Okay, so here's our game plan for breaking this all down. First, we're going to look at the price shock itself. Then we'll zero in on the exact geographical choke point at the heart of this whole mess. After that, we'll see how the supply chain basically seized up, we'll track the ripple effects across the globe, and finally, we'll explore what the experts think might happen next.
So let's start with that massive price jump. What does a surge this big really mean when you put it in perspective?
Well, this wasn't just some random blip on the radar. This jump was the single biggest one-day gain we've seen since the crazy early days of the pandemic. It launched prices to a level that's been out of reach for years. It's a flashing red light that our world's energy supply is under some serious stress.
And you know what's really telling? How quickly all the experts had to scramble and redraw their maps. Check this out. This chart from ING Research came out before the crisis even fully hit, and they were already jacking up their price forecast for the year. That tells you the market was already getting tight, even before this latest shockwave.
Okay, so to really get the why behind this insane price surge, we have to talk about the where. And it all boils down to one of the most important and vulnerable waterways on the entire planet. So, for anyone who's not familiar, the Strait of Hormuz is this incredibly tight channel of water. You can basically think of it as the main superhighway that connects the Persian Gulf, with all its oil and gas, to the rest of the world. If you're trying to ship energy out of that region, this is pretty much the only way to go.
And just look at these numbers. They're kind of staggering. We're talking about a quarter of all the oil shipped by sea passing through this one little bottleneck. Almost 20% of global LNG, too. And for huge producers like Qatar, there is literally no other way out. It is, and this is no exaggeration, the world's energy choke point.
So that's the multi-trillion-dollar question, right? The threat of conflict has basically slammed the brakes on tanker traffic. So what happens when you clog up a global artery like this one? The whole system just starts to grind to a halt.
Right, so let's look at that immediate impact. What happens to the countries producing all this oil when they suddenly find their main exit doors locked shut? And bam, the first domino topples. Iraq, OPEC's #2 producer. Before all this, their southern oil fields were pumping out 4.3 million barrels a day. Almost overnight, that output plummeted by a staggering 70%. That is a huge amount of oil just gone from the market. And right on its heels, Kuwait. They're the 5th largest producer in OPEC, and citing threats to their ships, they announced production cuts. But here's the key part. They declared force majeure. That's basically the legal way of saying, hey, we can't deliver on our contracts because of something totally out of our control. That's a very serious move. And you gotta understand, it's not as simple as just turning off the pumps. For the big players like the UAE and Saudi Arabia, it becomes a massive logistics nightmare. Their tankers can't get out of the Gulf, so their storage tanks on land are filling up fast. And once those are full, they have no choice but to shut down production. There's just nowhere for the oil to go.
So, to put this all into perspective, shutting down the strait has basically ripped 20 million barrels per day out of the market. Now look at this comparison from Goldman Sachs, because this is where it gets crazy. They figure the impact of this disruption is 17 times, yes, 17 times larger than the biggest hit to Russian oil after the 2022 invasion of Ukraine. We are talking about a shock on a completely different level.
Okay, so the producers are in total crisis mode. But what does that mean for the rest of us? For all the countries and people who depend on that oil every single day? Well, this is where that shockwave really starts to travel around the world. Let's just take India as an example. It's this huge, booming economy, but it has to import almost 85% of its crude oil. So for a country like that, a supply shock isn't some abstract problem, it's an immediate economic crisis. And let's be real, an economic crisis quickly becomes a political one. When gas prices skyrocket, governments come under huge pressure. And you can see that pain right here. This is the Indian rupee, which plunged to 92.25 against the US dollar, which is getting dangerously close to an all-time low. And since oil is bought and sold in dollars, a weaker currency means India has to shell out even more for every single barrel, creating this nasty, vicious cycle. And from there, the economic dominoes just keep on falling. A country's import bill balloons, and its currency gets hammered. Higher fuel prices mean it costs more to transport everything, which just pours gasoline on the fire of inflation. And it hits industries you might not even think about. The cost of raw materials for things like paint and car tires suddenly skyrockets. And of course, the airlines get absolutely crushed by the rising price of jet fuel. So we've seen the shock, we've seen the immediate damage. The big question, the $100 a barrel question, I guess, is where do we possibly go from here? Well, analysts are basically looking down three very, very different roads. This table from ING Research lays it out pretty clearly. Scenario 1 is the diplomatic route. A deal gets done, sanctions get eased, and more supply flows back into the market. Scenario 2 is a limited conflict. No deal, but things stay contained and don't hit the energy facilities. And then there's Scenario 3, the one nobody wants to see, a prolonged conflict which leads to retaliation and puts all the oil supplies in the Gulf at risk.
So here's the bottom line. The gap between the best case and worst case scenarios is absolutely massive. A diplomatic success could calm things down and see prices fall back to a much more manageable $55 to $60 a barrel. But a long, drawn-out conflict could send prices spiking to $140 a barrel. A price that high would be devastating for the global economy.
And that leaves us with this final, kind of sobering question. This whole crisis has laid bare a massive vulnerability right at the heart of our global economy. If a problem in one tiny stretch of water can bring the entire system to its knees, it really forces us all to ask, is our modern world built on a solid foundation of oil, or is it just a house of cards?